And Professor Siegel, I know that you are of the opinion you can't time the bottom, but stocks have come down significantly. This might be a very good time to buy. But I'd like to get you to talk about some of the comments we just heard from Ken Rogoff, Professor Ken Rogoff. He's of the opinion that these low interest rates we've seen might be a thing of the past, no matter what happens, even if the Fed's able to tame inflation, that we have seen times in the past where we see blips of lower interest rates, but that eventually they go away. He thinks there's a reversion to the mean here, and there are a lot of implications for what that means from everything for the markets to policymakers and what they'll be able to do. Do you agree with him?
Well, yeah, and it was a very interesting interview, and I know Ken very well. I agree and I disagree with a couple things he said. First of all, at the end, he said to the Fed, don't get inflation down to 2% too fast. And I agree completely with that, that the Fed, as you know, needs to go slower. I have to disagree with him on the interest rate. The actual decline in real interest rates really began right after 2000 and have been steady, not just 2007 financial crisis. And it is due to slower real growth around the world, slower productivity growth, slower population growth. I mean, around the world, all those things economists say, lower real interest rates. Also, we have an older population that is more risk averse, goes more into bonds as you get older. That increases the demand for bonds. And bonds, until this year, have been one of the best short-term hedges against the stock market that we have. And so that's another factor. And so I think that the decline in real interest rates is really much more permanent than he suggests. And I think real interest rates are going to go back down after the Fed becomes less aggressive in its monetary policy stance.
You think that the Fed is going to be less aggressive in the near future? Because that's certainly what the market seems to be indicating, the equities market, at least over the last couple of days.
Well, you know, I agree with what Mike Santoli said. I think the JOLTS data gave the stock market a jolt. And I hope it gives the Fed a jolt to say, hey, you know what? Things are slowing a lot faster than perhaps they even thought possible. I mean, in today's Wall Street Journal article, there was an article that said that home builders are offering buyers, not final buyers, but bulk buyers, 20% discounts to take homes off their hands. They are not getting any traffic with the surge in mortgage rates and the softening in prices. However, if you know the personal consumption deflator, the CPI, that won't record in deflation in the housing index. I mean, we talked about those lags. That's my biggest worry. They're going to keep on looking at housing inflation in the official indexes, while on the ground, there's absolutely no question the housing is going down. And that's a very, very important factor. We just heard of on your program just a half hour ago, what's going on with car loans and what that might do to car selling. All the signs are there for a slowdown. The Fed must recognize that and temper their hawkish stance. I think that's really why the market is rallied, particularly first day of the quarter is often a rally, especially if it's been sold down the week before. So that was certainly Monday. Tuesday, I think the JOLTS data said, just a minute, really, the Fed is hopefully going to get it. Now, will it show up in the Friday data that soon? We'll have to wait and see on that.